Debt can feel overwhelming, but knowledge is power. Learn strategies for tackling debt and making better choices moving forward. Any money you owe another person, business, or organization is considered debt. So whether you're charging a credit card or taking out a loan, you are accumulating debt. Charges for the services you rely on day to day, including rent and utilities, are also forms of debt.
Ignoring debt or letting it defeat you is not the path toward financial empowerment. Facing down debt can help you feel more in control of your finances. Start by clearly identifying the steps you're going to take to pay it down, and then follow through. Even small steps can help your debt feel more manageable. But first, let me ask you, do you know the difference between secured and unsecured debt? Secured debt is attached to an asset. In other words, the debt is backed by collateral or something of value your creditor can seize if you fail to make regular payments. Here are some common examples of secured debt. A home mortgage loan secured by the property you're buying. An auto loan secured by the car. A pawn loan secured by a personal possession like jewelry or electronic equipment. Rent-to-own agreements are secured debt because the creditor can seize the item like the couch or television or another item if you fail to pay. Debt from a secured credit card if secured by funds you deposit at a bank. Unsecured debt isn't secured by an asset. Unpaid unsecured debt often goes directly to collections since there is no collateral to repossess. Most credit cards and charge cards through department stores or big box retailers are unsecured debt. Here are some other types of unsecured debt many Americans are trying to manage. Many people take out student loans to continue their education. Whether the debt is through federal student loans or private student loans, late payments will affect your credit history. Unpaid debt will be managed through a collections agency. Many people have solid credit until they incur medical debt. You should review and address any disputes that may arise with your insurance provider. Reach out to the hospital or other healthcare facility providing services to negotiate a payment plan for expenses not covered by insurance. A payday loan or a cash advance is a short-term loan, generally for $500 or less. The lender might provide cash, load the funds onto a prepaid card, or electronically deposit the money into your checking account. Payday loans are generally due on your next payday. You must either give the lender access to your checking account by electronic debit or write a post-dated check for the full balance in advance so the lender can deposit your check when the loan comes due. Lenders sometimes require a borrower to provide a pay stub or benefits receipt to disclose their income to complete an application. The cost of the loan may range from $10 to $30 or more for every $100 you borrow, far above a standard interest rate charged for a typical loan, or even above what most credit cards charge. So a typical 2-week payday loan with a $15 fee per 100 equals an annual percentage rate of almost 400%. The cost of payday loans can creep even higher if there isn't enough money in your checking account to cover the loan payment when it's due. The bank may assess fees for an overdrawn account or return a post-dated check if there are insufficient funds in your account. If you take out an auto title or vehicle title loan, you're typically required to own your car free and clear. The lender keeps your car title as collateral. Auto title loans are usually equal to between 25% and 50% of the car's total value. These types of loans tend to have an annual percentage rate of about 300% for a 30-day single payment loan. If you can't repay the loan, your car can be repossessed. If your car is repossessed, you'll owe the remainder of the loan plus the repossession fees. If your debt is not settled, your car may be sold at auction. If a borrower cannot pay back a short-term loan when due, they sometimes further complicate their finances by taking out a second loan to pay the first loan. It's easy to fall into a cycle of borrowing when you're trying to cover short-term loan payments, in addition to regular expenses like food and rent and transportation. If you're considering a short-term loan product to meet an immediate need, it's important to think about how you will pay off the loan before you borrow more. Studies show that loans most likely to lead to a cycle of borrowing have the following features: payday loans generally for less than $500, short-term payment schedules like 14 days, requirements that borrowers provide their bank account information to the lender to facilitate automatic payments. If you don't have sufficient funds in your account at the time on the date payments are due, you may have to pay fees to your bank for insufficient funds in that account. Make sure you know how you'll repay your loan and how much the loan could ultimately cost before agreeing to use any form of credit. If you're short on cash, consider some alternatives to borrowing small amounts of money for a short period of time. Negotiate with your lender for more time to pay. Stop and think about why you're borrowing the money. Is it a need, an obligation, or a want? Use a credit card if you have one available. It will increase your monthly card payment, but it could be cheaper in the long run depending on the interest rates and fees. Ask your bank about lower cost, short-term loan alternatives. Access emergency funds. Discuss the situation with a credit counselor or financial coach. Borrow from a friend or a family member. Debt settlement companies will promise to renegotiate, settle, or in some way change the terms of your unsecured debt to a creditor or a debt collector. Consumers are often told if they work with settlement companies, the balance on their debt will be reduced. Interest rates will be lowered or fees for late payments will be eliminated. Before signing up, though, consider contacting your creditors directly about a payment plan. Red flags about debt settlement companies include charging any fees before settling your debts, promoting a new government program to bail out personal debt, guarantees that it can make debt go away or stop all debt collection calls and lawsuits, directions to stop communicating with creditors, claims that unsecured debts can be paid off for pennies on the dollar, advice that includes stop making payments to creditors.